Meet Sarah Chen, a 28-year-old graphic designer living in Austin, Texas. Like millions of Americans, she's been working hard, saving money, but watching her savings account earn practically nothing. Today, that changes. It's Monday morning, March 2023. Sarah sits in her favorite coffee shop, the same corner table she's occupied every Monday for 2 years. She's scrolling through her phone when an article catches her eye. The average stock market return is 10% annually. She pauses. Reads it again. 10%. Her savings account? 0.5%. She does the mental math. On her $12,000 in savings, that's the difference between earning $60 a year and $1,200 a year. The same money, just working harder. But Sarah's scared. $12,000. It took her 3 years to save that. 3 years of skipping vacations, eating lunch at her desk, saying no to weekend trips with friends. Every dollar represents a sacrifice, a choice, a piece of her life. She remembers the 2008 financial crisis. She was only 13. But she remembers her parents' fear, the hushed conversations late at night, the words foreclosure and bankruptcy whispered like curses. Her father lost half his retirement savings. The stock market, in her mind, is where dreams go to die. But she also remembers her grandfather. He passed away 2 years ago and left her $5,000. Don't be afraid of money, he told her when she was young. Money is a tool. Fear makes it useless. Greed makes it dangerous. Wisdom makes it powerful. Sarah opens her banking app. $12,347. All sitting there. Safe. Earning basically nothing. Losing value to inflation every single day. She's not building wealth. She's treading water. She makes a decision. Not a reckless one, but a calculated one. She'll learn. She'll start small. She'll treat this like the education she couldn't afford in college, except this education might actually pay dividends. Sarah downloads an investing app. Her hands shake slightly as she creates an account. This feels real in a way that reading articles never did. She's not just thinking about investing anymore. She's doing it. The app asks for her social security number, her date of birth, her banking information. Each field she fills out feels like a commitment, a step towards something she doesn't fully understand but knows she needs to learn. When she links her bank account, she sees all $12,000 available to invest. The temptation is there, go all in, make up for lost time. But she hears her grandfather's voice, scared money don't make money, but stupid money loses it all. Sarah decides on $1,000. Enough to matter if she loses it, enough to learn from if she grows it. She stares at the deposit funds button for what feels like an eternity. Her thumb hovers. Her heart races. She thinks about all the reasons not to do this. Then she thinks about being 65, still working, still broke, still scared. She presses the button. Transfer initiated. Funds will be available in 2 to 3 business days. Sarah releases a breath she didn't know she was holding. She's done it. She's taken the first step. There's no going back now. Wednesday morning. Sarah wakes up 30 minutes before her alarm. She couldn't sleep. Her $1,000 hit her account yesterday, and today the market opens. Today, she becomes an investor. She makes coffee with shaking hands. This is ridiculous, she thinks. It's just stocks. But it doesn't feel like just stocks. It feels like the beginning of something. A different path. A path away from living paycheck to paycheck, from anxiety about unexpected expenses, from the feeling that she's running in place financially. Sarah opens her laptop at the kitchen table. She's spent the last 2 nights researching. Not random tips from social media. Real research. She's made a list of companies she understands, companies whose products she uses, whose business models make sense to her. Apple. She's owned iPhones since college. Microsoft. She uses their software every day at work. Starbucks. Well, that's obvious, she's practically keeping them in business single-handedly. Nike. She runs 5 miles every morning in their shoes. But knowing companies and knowing their stock value are different things. She opens each company's investor relations page. She reads their latest quarterly reports. Most of it is financial jargon she barely understands, but some things are clear. Apple is making record profits. Microsoft's cloud business is growing. Starbucks is expanding internationally. She looks at stock prices. Apple, $152 per share. Microsoft, $320. Starbucks, $95. Nike, $108. With $1,000, she can't buy much. She calculates different combinations. 3 shares of Apple and 2 of Starbucks? 1 Microsoft and 3 Nike? Sarah decides to start with what she knows best. Apple. She uses their products. She believes in their future. She's read that Warren Buffett owns billions of dollars worth of Apple stock. If it's good enough for the greatest investor of all time, maybe it's a reasonable first purchase. 9:30 a.m. The market opens. Sarah's heart pounds. She navigates to Apple's stock page. The price is moving. $152.10. $152.15. $151.98. It's alive, fluctuating with every second. Every change represents millions of dollars moving around the world. She sets up her first trade. Buy 3 shares of Apple at market price. Her finger hovers over the confirm button. This is it. Once she presses this, she's no longer someone who thinks about investing. She's an investor. She presses it. Order executed. You now own 3 shares of Apple Incorporated at $152.34 per share. Sarah stares at the screen. She owns Apple. A tiny, microscopic piece of one of the world's most valuable companies, but still, she's a shareholder. She's in the game. The next hour is torture. She checks her phone every 3 minutes. The stock moves up, down, up, down. At 10:15 a.m., she's up $4.50. At 10:47, she's down $2.10. At 11:30, she's up $7.20. By lunch, she forces herself to close the app. This is insane. She can't check it every 5 minutes. She's in this for the long term. That's what all the research said. Long term. Years, not hours. But she checks it anyway. The stock is up $2.13 per share. She's made $6.39 in one morning. Her savings account would take 2 months to earn that much. Sarah feels something she hasn't felt about money in a long time: hope. Not the desperate hope that comes from buying lottery tickets. Real hope. The kind that comes from taking control, from learning, from acting instead of just wishing. That evening, she opens a spreadsheet. She titles it Investment Journey. She records her first purchase, 3 shares of Apple, $457.02 total cost, purchase date, her reasoning for buying. She creates columns for future purchases, for tracking performance, for notes on what she learns. This isn't gambling. This is building. And Sarah Chen is laying her first brick. Sarah can't sleep. It's been 3 days since her first purchase, and her brain won't shut off. She lies in bed with her laptop, going down rabbit holes. What's a PE ratio? What does market cap actually mean? Why do some stocks pay dividends and others don't? She discovers YouTube channels dedicated to investing. She finds one hosted by a retired teacher who explains concepts like he's talking to his grandmother. No jargon. No complexity. Just clear, simple explanations. A stock, he says, is ownership. When you buy a share of Apple, you own a piece of that company. A tiny piece, but a real piece. You're not gambling on numbers going up and down. You're betting that this business will be more valuable in the future than it is today. Something clicks for Sarah. She's not trading numbers. She's buying businesses. That changes everything. She learns about Warren Buffett's investment philosophy: buy great companies at fair prices and hold them forever. She learns about Peter Lynch's advice: invest in what you know. She discovers index funds, baskets of stocks that let you own tiny pieces of hundreds of companies at once. The more she learns, the more she realizes how little she knew. The stock market isn't a monolith. It's thousands of individual companies, each with their own story, their own potential, their own risks. Some will thrive. Some will fail. The trick is figuring out which is which. Sarah spends her weekend creating an investment strategy. She writes it down, makes it official. Rule 1: only invest money she won't need for at least 5 years. The stock market is volatile short term, but historically always grows long term. Rule 2: diversify. Don't put all her eggs in one basket, no matter how much she loves that basket. Rule 3: invest regularly. $500 every month, no matter if the market is up or down. This is called dollar cost averaging. Sometimes she'll buy high, sometimes low, but over time it averages out. Rule 4: understand what she owns. If she can't explain why she bought a stock in 3 sentences, she shouldn't own it. Rule 5: control her emotions. Fear and greed kill more investors than bad stocks ever will. She prints this out and tapes it to her bathroom mirror. Every morning, she'll see these rules. They're her guardrails. Her protection against her own worst impulses. Monday comes. Sarah's second investment. She's got $543 left from her initial $1,000. She decides on Microsoft, 2 shares at $320 each. But this time, she doesn't just buy. She reads the company's latest earnings report. She watches the CEO's quarterly presentation. She understands what she's buying, a company dominating cloud computing, growing its AI capabilities, with products used by billions. She makes the purchase. No shaking hands this time. No panic checking every 5 minutes. Just a calm, informed decision. Tuesday evening, Sarah joins an online investing community. Not the ones promising 10x returns in 90 days or this one stock will make you rich. She finds a forum of people like her, beginners learning together, sharing research, asking stupid questions without judgment. She lurks for a few days, reading threads. Someone asks, "Should I sell? I'm down 5% this week." The response from a veteran investor changes Sarah's perspective. You're not down anything unless you sell. Stock prices fluctuate. Company value grows over time. Learn the difference. Another thread discusses the 2008 crash. Someone posts a chart showing the S&P 500 from 2007 to 2024. Yes, it crashed 50% in 2008. But by 2013, it had fully recovered. By 2024, it had tripled from the crash bottom. Everyone who sold in panic lost. Everyone who held and kept buying got rich. Sarah takes a screenshot of that chart. When she feels scared, she'll look at it. Remind herself that short-term pain often leads to long-term gain. By the end of March, Sarah has invested her full $1,000, Apple, Microsoft, and a low-cost S&P 500 index fund. 3 holdings. Simple. Diversified enough to be safe, concentrated enough to track easily. Her portfolio value, $1,047. She's up $47 in 2 weeks. But more importantly, she's learned more about finance in 2 weeks than in her entire life before. Knowledge, she's realizing, is the real return on investment. April 17, 2023. Sarah's at work when her phone buzzes. A news alert, market down 4% on banking fears. Her stomach drops. She pulls at her phone, opens her investing app. Red. Everything is red. Her portfolio, which had grown to $1,380 with her monthly contributions, is now $1,247. She's lost $133 in 6 hours. That's almost a full day's pay, gone. Her hands start shaking. This is what she was afraid of. This is why her parents lost everything in 2008. The market is crashing, and she's about to lose her hard-earned money. She opens a browser. Should I sell my stocks? The first article she finds says yes, protect your capital, cut your losses, wait for stability. It makes sense. Sell now, save what's left, buy back in when things calm down. Her finger hovers over the sell all button. One tap and she's out. Safe. Maybe down a bit, but protected from further losses. But something stops her. She remembers the chart from the forum. The one showing 2008. Everyone who sold in panic lost. Everyone who held and kept buying got rich. Sarah closes her app. She doesn't sell. Instead, she does something harder. She goes back to her research. Why is the market down? Banking fears. What does that actually mean? She reads the actual news, not just the headlines. A mid-sized bank failed due to poor management and risky investments. It's being taken over by the FDIC. Depositors are protected. The companies she owns, Apple, Microsoft, have nothing to do with this bank. Their businesses haven't changed. Their products haven't gotten worse. Only their stock prices have dropped. And then Sarah understands something crucial: stock prices and company value aren't always the same thing. The market panicked. Prices dropped. But the underlying businesses? Still solid. She looks at her watch list. Microsoft, which she'd wanted to buy but thought was too expensive at $320, is now trading at $289. Apple, at $152 when she bought it, is now $142. Everyone else is scared. They're selling. But Sarah remembers Buffett's advice: be fearful when others are greedy, and greedy when others are fearful. This isn't the time to sell. This is the time to buy. Sarah checks her bank account. She was planning to invest $500 next week anyway. Instead, she invests it now. She buys one more share of Microsoft at $289, and two more shares of Apple at $142. That night, she can barely sleep. Not from fear this time, but from adrenaline. She did the opposite of her instinct. She bought when everything in her screamed to sell. The next day, the market rebounds slightly. Still down, but not as badly. Sarah's portfolio, $1,298. Better than yesterday. 2 days later, $1,356. A week later, $1,402. By early May, the crisis is forgotten. Markets have not only recovered but pushed higher. Sarah's portfolio is worth $1,523. The shares she bought during the panic? Up 18% from her purchase price. She opens her investment journal and writes, April 17, 2023. The day I learned that volatility is the price you pay for long-term returns. Everyone who sold lost. I bought. Lesson learned, when everyone is panicking, read the research, understand the facts, and if nothing fundamental has changed, stay the course or buy more. But Sarah's biggest test is still coming. Because life doesn't care about your investment strategy. May 22nd. Sarah's driving to work when her car makes a sound no car should make. She pulls over. Steam is rising from the hood. She calls a tow truck, gets the car to a mechanic. The diagnosis, transmission failure. The cost, $3,200. Sarah sits in the mechanic's waiting room, doing math in her head. Her emergency fund has $1,800. Her car insurance has a $500 deductible. She's $1,400 short. She has money. She has $1,523 in her investment account. She could withdraw it, pay for the repair, and rebuild later. But she also remembers her rules. Rule 1, only invest money you won't need for at least 5 years. She broke her own rule. She didn't build a proper emergency fund before investing. Sarah calls her mom. Not for money, she won't do that. But for advice. Her mom listens, then says something that sticks. Pride is expensive, honey. But so is bad financial planning. Fix the car, learn the lesson, and don't make this mistake again. Sarah takes out a 12-month personal loan for $1,500 at 8% interest. It hurts. The interest will cost her about $100. But she doesn't touch her investments. That night, she creates a new plan. She pauses her $500 monthly stock investments. Instead, that money goes to 3 things: $200 to the car loan, $200 to rebuilding her emergency fund to $5,000, and $100 to her investments. She refuses to stop completely. It will take 8 months to get back on track. 8 months of watching the market without fully participating. 8 months of discipline over desire. June passes. July. August. Sarah watches friends post on social media about their investment wins. The market is up 12% since April. She's missed most of it, stuck rebuilding her foundation. But she doesn't quit. $100 a month, every month, into her investment account. It's not much, but it's movement. And she's learning something more valuable than quick returns. Patience and systems matter more than perfect timing. January 2024. Sarah's car loan is paid off. Her emergency fund stands at $5,000. After 8 months of discipline, she's ready to fully resume investing. But she's not the same person who started 10 months ago. She's learned the hard way that investing isn't just about picking stocks. It's about building a complete financial foundation. Emergency fund first, then investing. Always. Her portfolio, even with minimal contributions, has grown to $2,100. The $100 monthly investments added up. The companies she owned grew in value. Time and consistency did their work. Sarah recalculates her strategy. With her expenses covered and emergency fund solid, she can now invest $600 monthly. $300 into her SP 500 index fund for stability, $300 into individual stocks for growth and learning. February brings an opportunity. Her company announces a 401k program with matching contributions. For every dollar she puts in up to 6% of her salary, they'll add 50 cents. Free money. Guaranteed return. Sarah does the math. She makes $52,000 a year. 6% is $3,120 annually, or $260 per month. Her employer will add $1,560. That's a 50% return before the money even invests. She immediately enrolls, maxing out the match. Now she's investing on two fronts: $600 in her personal account, $260 in her 401k, becoming $390 with a match. Nearly $1,000 a month building her future. March. Sarah receives her tax refund, $1,200. Old Sarah would have bought a new laptop or taken a weekend trip. New Sarah sees opportunity. She invests the entire refund into her portfolio, split between index funds and individual stocks she's researched. April marks 1 year since the crisis that taught her about volatility. She looks back at her journal entry from that day. The fear in her words. The panic she felt. She checks those stocks she bought during the crash. Microsoft, purchased at $289, now trading at $380. Apple, purchased at $142, now at $175. By staying calm and buying during fear, she turned crisis into opportunity. Those shares alone are up over 30%. But Sarah's learning something deeper. She's not investing to get rich quick anymore. She's investing to build a life where money doesn't control her, where unexpected expenses don't derail her, where she has options. May brings a dinner with old college friends. The conversation turns to money. It always does eventually. Everyone's complaining about inflation, about how nothing's affordable, about how they're broke despite working full-time jobs. Sarah listens. She doesn't lecture. But when asked how she's managing, she mentions she's been investing. Isn't that risky? Someone asks. What if you lose it all? Sarah smiles. Riskier than keeping it in a savings account earning nothing while inflation eats 3% annually? I spent 10 months learning before I risked significant money. Now I understand what I'm doing. Her friend Emma, the youngest in the group at 22, leans in. Could you teach me? I just got my first real job. I'm making $45,000 and I have no idea what to do with money beyond paying rent. 2 days later, Emma sits in Sarah's apartment. Sarah doesn't overwhelm her. She starts simple. Before you invest a single dollar, you need 3 things: a budget that works, $1,000 for emergencies, and understanding that investing is long-term. She shows Emma her own journey. The spreadsheets. The journal. The mistakes. The wins. I started with $1,000 and a lot of fear. You can start with $500. The amount doesn't matter. Starting matters. Emma asks the question everyone asks, what should I buy? Sarah pulls up a chart of the S&P 500 over 30 years. See this? It includes 500 of America's biggest companies. It's gone up an average of 10% annually for nearly a century. Instead of trying to pick individual winners, just own them all through an index fund. Invest $100 every month, and don't stop for 30 years. She does the math on screen. $100 monthly for 30 years at 10% average returns equals $227,000. Emma's eyes widen. From just $100 a month? Compound interest, Sarah explains. Time is your biggest advantage at 22. You have 40+ years until retirement. I started at 28. You're getting a 6-year head start on me. 2 weeks later, Emma texts a screenshot. She's bought her first index fund share. $87. Sarah feels something she didn't expect: pride. Not just for Emma, but for herself. She's gone from terrified beginner to someone who can guide others. June 2024. Sarah's total net worth calculation: $5,000 emergency fund, $4,200 in personal investments, $2,100 in her 401k, car paid off. Total, $11,300, plus no debt besides student loans she's steadily paying down. A year ago, she had $12,300 in a savings account doing nothing. Now she has less cash but more wealth. The difference? Her money is working, growing, building. She opens her laptop and updates her investment journal. She writes, 15 months into this journey, I've learned. Lesson 1, the best time to start investing was 10 years ago. The second best time is today. I can't get back the years I wasted being scared, but I can make the most of the years ahead. Lesson 2, investing isn't about being smart or lucky. It's about being consistent and patient. I invested through crashes, through personal crises, through doubt. Consistency won. Lesson 3, you can't time the market. I tried. Everyone tries. The winners are the ones who stop trying and just invest regularly regardless of market conditions. Lesson 4, emergency funds aren't optional. I learned this the expensive way. Now I sleep better knowing I can handle whatever life throws at me. Lesson 5, knowledge compounds like interest. Every book I read, every mistake I learned from, every journal entry I wrote, it all adds up to understanding that protects me from my own worst impulses. Lesson 6, fear and greed are the investor's real enemies. Stocks, crashes, volatility, those are just circumstances. My own emotions are what will make or break me. Lesson 7, the goal isn't to get rich quick. It's to get wealthy slowly. To build a foundation so solid that by the time I'm 50, I have options. By the time I'm 60, I have freedom. I'm not rich. My portfolio isn't huge. But for the first time in my life, I'm not scared about money. I have a plan. I have knowledge. I have discipline. And most importantly, I have time. Sarah closes her journal and looks at her goals for the next 12 months. Reach $10,000 in personal investments. Max out her 401k match. Build her emergency fund to 6 months of expenses. Teach at least 5 friends the basics of investing. But there's one more goal, one she writes in bold letters. Never forget what it felt like to be broke and scared. Stay humble. Stay curious. Stay disciplined. Today, Sarah Chen continues her journey. Her portfolio grows not through genius or luck, but through the simple power of consistent action over time. She'll face more crises, more doubts, more temptations to quit or change course. But she's built something more valuable than a stock portfolio. She's built a system, a mindset, a relationship with money based on respect, not fear. The stock market has created more millionaires than any other wealth vehicle in American history. Not through day trading or speculation, but through patient, disciplined, long-term investing. Sarah is on that path now. She started with $1,000 in terror. 15 months later, she has knowledge, confidence, and a growing portfolio. In 10 years, she'll have 6 figures. In 30 years, she'll have financial freedom. But the real transformation isn't in her bank account. It's in her mirror. She's no longer the woman who was afraid to try. She's the woman who learned, who persevered, who teaches others. The market is open 253 days a year. Every single one of those days is an opportunity to build wealth. The question isn't whether you can do this. The question is, will you? Your grandfather gave you advice. Your fear gave you hesitation. Your discipline will give you freedom. The journey of 1,000 miles begins with a single share. What will yours be? This is Sarah's story, but it could be anyone's story. Maybe it's your story waiting to begin. The principles she learned aren't secret. They're not complicated. They're just uncommon in practice. Start before you're ready. Sarah began with fear and $1,000. She didn't wait until she understood everything. She learned by doing. Invest in what you understand. She bought companies whose products she used, whose business models made sense. No speculation. No hype. Just real businesses creating real value. Time beats timing. She couldn't predict market crashes or rebounds. Nobody can. So she invested consistently, monthly, regardless of market conditions. Dollar cost averaging isn't exciting, but it works. Emotions are expensive. Fear made her want to sell during the April crash. Greed made her want to buy the hyped IPO. Discipline saved her from both. The market is designed to transfer money from the emotional to the patient. Build the foundation first. Her car breakdown taught her that investing without an emergency fund is building a house on sand. Foundation first, then growth. Compound interest is real. $100 monthly doesn't sound like much. Over 30 years, it becomes $227,000. Not from magic. From mathematics. From time. From consistency. The stock market isn't a casino. It's not gambling. It's ownership in the American economy. When you buy stocks, you're betting that humans will continue to innovate, create, and solve problems. For over a century, that bet has paid off. Since 1926, the S&P 500 has averaged 10% annual returns. Not every year. Some years it's down 20%. Some years it's up 30%. But over time, over decades, the trend is undeniable, up and to the right. The Americans who built wealth through stocks weren't geniuses. They were teachers, nurses, plumbers, designers like Sarah. Regular people who understood one simple truth: owning pieces of great businesses over long periods builds wealth. You don't need $10,000 to start. You don't need an economics degree. You don't need to quit your job and become a day trader. You need a plan, discipline, and time. Sarah started at 28. She wishes she'd started at 22. But she didn't. She can't change that. Neither can you change your past. But you can change your future. Every dollar you invest today is a soldier working for your future freedom. Every share you buy is a piece of economic growth you're claiming. Every month you stay disciplined is a month closer to financial independence. The market is open. The opportunity exists. The question isn't whether this works, a century of evidence says it does. The question is whether you'll have the courage to start and the discipline to continue. Sarah Chen was terrified 15 months ago. Today, she's teaching others. That transformation didn't require genius. It required a decision. What will you decide? The first step is always the hardest. The second step is easier. By the 100th step, it's just who you are. Start small. Start scared. But start. Your future self will thank you. This story is based on realistic investing principles and timelines. Past performance doesn't guarantee future results. This is educational content, not financial advice. Consult a financial professional before making investment decisions. Resources: Investor.gov SEC Educational Resources. The Simple Path to Wealth by J.L. Collins. The Little Book of Common Sense Investing by John Bogle. r/Bogleheads community on Reddit. Ready to start your journey? Check out our beginner's guide in the description. Subscribe for more real-world financial education. Today, Sarah's journey continues. Her portfolio grows not through luck or genius, but through consistent action, continuous learning, and unwavering discipline. She's discovered what every successful investor knows: the stock market isn't a casino where you gamble. It's a marketplace where you become an owner. An owner of businesses. An owner of innovation. An owner of the future economy. The lessons she learned are simple but powerful. Lesson 1: Start small, but start now. Time in the market beats timing the market. Lesson 2: Diversification protects you. Don't put all your eggs in one basket, no matter how promising that basket seems. Lesson 3: Emotion is the enemy. When you're excited to buy, be cautious. When you're scared to buy, be brave. Lesson 4: Understand what you own. If you can't explain why you bought it, you shouldn't own it. Lesson 5: Investing is a marathon, not a sprint. Get-rich-quick schemes make you poor quickly. Get-rich-slow strategies make you wealthy eventually. Sarah's story isn't unique. Millions of Americans are building wealth through the stock market every single day. The difference between those who succeed and those who fail isn't intelligence or luck. It's behavior. The stock market has created more millionaires than any other vehicle in history. Not through day trading or speculation, but through patient, disciplined, long-term investing in quality businesses. Sarah started with $1,000 in fear. Today she has $8,000 in confidence. In 10 years, she'll have 6 figures. In 30 years, she'll have financial freedom. The question isn't whether you can do this. The question is whether you will. The market is open. Your future is waiting. What will you do with it?